We've all been there, right? You see what looks like an easy way to save some cash.
Like finding a discount code just as you're about to pay online.
Exactly. Well, today we're diving into something similar, but with much bigger stakes. Should you switch your personal loan just because you found a slightly lower interest rate?
Yeah, it sounds like a no-brainer on the surface. Less interest, more money for you. Simple.
But hold on a second. It's often not quite that straightforward, is it?
That's really the heart of it. I mean, a lower rate always looks good, but making smart financial moves means you gotta dig a bit deeper.
Look beyond the headline number.
Precisely. You need to see the whole picture. So today, we're going to break down a really common scenario, see if that small rate drop actually saves you money in the end.
Okay, let's paint the picture. Say you took out a loan for $11,050,000.
Okay.
The interest rate was 10.75%, and the plan was to put it off over 5 years.
Standard enough.
So 2 years down the line, you've been making all your payments, your EMIs.
Your equated monthly installments, yeah.
Right, and now you owe $7,050,000. Then, boom, another bank comes along.
The tempting offer.
They offer to refinance that remaining $7.5 lakh at 10.50% lower rate.
Okay, 0.25% lower.
Yeah. My first thought is great, lower rate, less interest. But you're saying maybe not. What's the catch?
Well, you're right to pause. Because, while that 0.25% sounds good, there's often a snag. In this case, your current bank, the first one, they're going to charge you a prepayment penalty if you leave early, a 3% penalty.
Ooh, okay.
So our mission basically is to crunch these numbers. Does that slightly lower rate actually beat the cost of switching banks? We need the total cost.
You got it. Total impact, not just the interest rate sticker price. Okay, so step one, what happens if you just stay put?
Right, the baseline. Keep things as they are.
You've been paying $24,882 each month, and you've got 3 years left. That's 36 months.
Okay, so if you stick with it, it's simple math. 24,882 times 36 months.
Which works out to $8,095,752. That's the total you'll pay from here on out.
Exactly. And remember, you still owe $7,050,000 on the principal amount.
Ah, right. So the interest part of that total future payment is the difference.
Correct. You take the total payments, $8,095,752, subtract the principal you still owe, $7,050,000.
And that leaves $1,045,752. So that's your total interest cost if you just ride out the current loan.
Pretty clear. That's option A laid out.
Okay. Now for option B, making the switch, what does that really cost?
Well, the very first thing, before even looking at the new loan's interest, is that penalty.
The prepayment penalty, you said 3%.
Yep, 3% of the outstanding amount, which is $7,050,000.
Okay, let me just 3% of $750,000. That's $22,500. Wow.
Yeah, it's not insignificant, is it?
Definitely not. That's a fair chunk of change you have to cough up just for the privilege of leaving. Does the interest saving often cover something like that?
That's the million-dollar question, or, well, the $22,500 question here. It certainly makes you think.
Okay, so that's the exit fee. Then there's the new loan itself.
Right, new loan, same principle.
Yeah.
$7,050,000, but the rate is now 10.50%.
And the term is still 3 years?
We're keeping it comparable, so yes, 3 years. This means a new EMI calculation.
Lower rate should mean a lower EMI, right?
It does. The new EMI comes out to $24,367 per month.
Okay, so a little bit lower than the old one. About 500 rupees less a month. Seems nice, but enough.
Well, let's see. You'll make 36 payments of that new EMI, $24,367.
So 36 times 24,367. That totals $8,077,212 over the 3 years.
And again, to find the interest paid on this new loan, we subtract the principal.
So $8,077,212 minus the $7,050,000 principal.
Gives you $1,027,212 in interest paid to the new bank.
Okay, so the interest itself is lower than staying put. It was over $1,045,000 before. Now it's about $1,027,000.
It is lower, but, and this is the crucial base.
We can't forget that penalty.
Exactly. That $22,500 you paid just to switch. To get the real total cost of switching, you have to add that penalty back in.
Right. So the new loan interest, $1,027,212, PLUS the penalty, $22,500.
Add them together. And the total cost of switching comes to $1,049,712.
Okay. Let's pause there. Let's put them side by side.
Good idea.
Staying put, total interest cost is $1,045,752. Switching, including the penalty, total cost is $1,049,712 shares.
So, what does that tell us?
It tells us switching actually costs more by about nearly 4,000 rupees. $3,960 more.
Isn't that something? Despite getting that lower interest rate, the overall cost is higher.
Wow.
And it really drives home the point.
Yeah.
You absolutely have to look at the total cost of borrowing. That headline rate, it's just one part of the puzzle.
The penalty just wiped out any savings from the lower rate and then some?
Exactly. That 3% penalty was just too big compared to the small, 0.25% interest rate
It
reduction.
really makes you question those lower rate offers. You think you're being smart, saving money, but nope.
It shows why you need to do the math.
Yeah.
Always. So what's the big takeaway here? What should people actually do?
Well, clearly don't just jump at a lower rate. But what else? Are there other moves you could make?
That's a really good point. Switching isn't the only option if you want to save on your loan. What else could you explore?
Like, could you attack the principal faster?
Potentially. You should definitely check with your current bank first. Ask them, can I make partial prepayments, and are there penalties for that?
Ah, so maybe you can pay extra towards the principal sometimes without triggering the full early exit penalty.
Sometimes, yes.
Mm.
Even small extra payments chip away at the principal faster, meaning less interest paid over time. Banks make a lot of their money early on when payments are mostly interest, which is, well, why those prepayment penalties often exist.
That makes sense. What about just asking your current bank for a better deal?
Absolutely. Negotiation. Don't underestimate it.
So you could go back to your bank and say, look, I've got this offer for 10.5% from someone else. Can you match it or get closer?
Yes. Tell them you're considering switching. They might be willing to lower your current rate to keep you as a customer. They might prefer a slightly lower rate than, losing your business entirely, even with the penalty.
It's always worth asking, isn't it? The worst they can say is no.
Exactly. Doesn't hurt to try.
Okay, so the main lesson seems to be look beyond the shiny lower rate, do the sums, factor in all the costs, especially those pesky prepayment penalties.
That's the bottom line. That tempting lower rate might actually leave you worse off. It's fascinating how a small percentage difference can swing the outcome when fees get involved. Makes you wonder.
It really does. It's about the total cost, end to end, not just one number.
And hopefully, by walking through this example step by step, you, the listener, kind of get a framework.
Yeah, a way to analyze these things for yourself.
Right. Apply this thinking to your own situation.
So, thinking about this, if a relatively small penalty like 3% can completely undo the benefit of a lower rate, it really makes you pause and think, doesn't it? What other hidden costs might be lurking in financial decisions we make? Things we might overlook?
That's a great question to ponder. It's a reminder to always look under the hood, check the small print, and understand the full financial picture before you leap.
Definitely food for thought. Always dig a little deeper.